there are a number of ways to mitigate sovereign and operating risks. And in using the ICCRC, we really have to understand how to adjust the cost of capital that comes out of a program based upon a credit rating or a country rating to recognize that some risks have been mitigated. Now remember, the way that I recommend that the international cost of capital is actually executed is to come up with a base cost of capital that reflects the fundamental risk of the business line. So something like an industry cost of capital to start with. And that's our base, that's our starting point. And then if the project has average risk to a particular country, then we can use the ICCRC to come up with a hurdle rate. And what I prefer to do is to take the difference between the ICCRC hurdle rate and the fundamental risk of the project. To take that difference and adjust the cash flows appropriately for that level of country risk. You can think of doing a decision tree type of analysis, looking at all the possible risks. And when we take the expectations by assigning probabilities to the branches, that reduces the cash flows from the most optimistic scenario to the expected scenario. And what I'm suggesting is that that adjustment, after assigning those probabilities, should exactly reflect the difference between the underlying fundamental risk and the country risk. So it is a way to calibrate the decision tree that delivers the cash flows. Now, it turns out that most projects that we consider are not projects of average country risk. That there's a number of things that can actually be done to mitigate that type of risk. So what we have to do is to actually go in and make our own adjustments. Now there's a number of different ways to do this, and some are more ad hoc than others. For example, we could actually go and we could look at the composition of, say, the ICRG composite rating that we could be using to calibrate our ICCRC. And the ICRG composite is composed of economic, financial, and political risks. And there's categories for each, and there's points scored in each of the categories. For example, in political risks, there's a category called expropriation. And we might be evaluating a project in an emerging market that's got fairly high probability of expropriation, which would be reflected in a low score. And suppose this factor has a total of 10 points, and this country might have a score of 1. Now, we actually look at the project, examine it, and it could be that the people that have structured the deal have worked very hard to structure a deal such that the change of expropriation is minimal. One case that we look at, the project depends upon inputs that come from all over the world, and even the running of the plant is done from a team that's brought in from outside the country. If that plant was seized, it's not functional. It has no value. So it doesn't make any sense to expropriate. Now, it's true that sometimes expropriations don't make any sense, but this one in particular makes no sense. There's no cash to be gained. There's no salvage value. So while the general expropriation risk for a country might be fairly high, for this particular project, instead of a 1, it could score a 9. And you can go through each of the factors that go into the ICRG and make adjustments on a project-specific basis. And what happens is you get a new rating. The new rating suggests a different hurdle rate, a lower hurdle rate. Now, you can get part of the job done this way, but there are other things that are project-specific, that are done in terms of structuring a deal, that are difficult to actually quantify in the ratings framework. There's many things that could happen to mitigate the probability of a disaster happening. There are ways to insure a project. Political risk insurance could be used. And this greatly reduces the sort of risks that people face. So what you really have to do is to make a list of all of the risks and then make an assessment of which risks are substantially mitigated by the actual structure of the project. Some adjustment can be made in the rating, but invariably other adjustments need to be made on a more ad hoc basis that, if they truly are mitigating the risks, would reduce the hurdle rate that we would use for the project evaluation. Unfortunately, there's no simple formula to actually do this. You have to go through risk by risk and figure out what the appropriate adjustment is. A lot of this is judgment. You know, international project evaluation is extremely difficult. At least we have some quantitative framework to use. We've got a quantitative framework that delivers the industry cost of capital. We've got a quantitative framework that tells us what the risk-reward trade-off is, what the expected rate of return is for a country project that has average risk. But every project is different, and most projects are different from the average. We have to make a series of adjustments.